It really does sound very cliche. The classic, invest in yourself, your greatest asset is your mind. You know, we have heard it so many times, and a lot of people use it in a sort of fluffy way, but it is absolutely 100% true. And I'm going to share my own perspective on it and why I do believe your brain is the absolute greatest asset that you have. And it's a different perspective, at least I think so. Why is the human brain the greatest asset above any other investment? Well, for a start, the brain is the genesis asset. All other assets was created by a collection of human brains or a human brain. Every global monopoly, every technology, this equipment that I'm using, YouTube, camera, technology, everything came from a thought, came from human thoughts, and it's the only asset that cannot be taken away from you. It cannot be shorted, it has no upper ceiling, and it compounds. In fact, it compounds greater than any stock, any investment. You can learn a fundamental concept once and it can pay off for the next 20 years of your life. It's the most important asset. And my opinion is most people do not appreciate that is their greatest asset. And people are trapped on linear solutions. And I'm going to talk about that. I thought this was interesting. We apparently know more about space than we do about the actual human brain. I don't know if it's true or not, but I heard it and I thought it was really interesting. I thought I'd add it in. You know, the brain, space doesn't lie to itself. Space is external. It doesn't change when you look at it. You can photograph it. You can't photograph a thought. It doesn't have bias, ego. It doesn't lie to itself. The brain has 100 trillion connections, no fixed law. Very interesting. I believe there's the investing is different than every other profession, where experience doesn't necessarily translate to a better investor. You see, in every other aspect, like so, if you look at a pilot, the more hours a pilot spends in a cockpit, naturally, they are so many hours better than someone who hasn't. Every other aspect, athletes, any other professional, the more they have done that job or that skill or that trait, they are naturally just better. But the opposite is said for capital allocation. Capital allocation doesn't really reward action. It rewards learning, thinking, and just patience. The opposite of the real world. So I would argue, if someone was to spend 6 to 12 months learning capital allocation, truly deeply understanding it, they would be a far better investor than someone who jumps straight into it because they maybe watched a retail finance channel that showed them the compound interest calculator and told them you can become a millionaire if you invest, $100 a month into an all-world fund. And that's it. That's as far as they go. They don't want to push the brain any further. But that's a massive problem because you must be a capital allocator. You have no choice, actually. You've got no choice in the game. You have to play this game of capital allocation. You have to invest in something. And it's the highest ROI skill is capital allocation. And as a result of that, thinking and learning, capital allocation is the highest. Most investors are just victims to the market. They're anxious when the market goes up. So when the market goes up and they see their account in a profit, they should be happy. But actually, they're anxious as equally as if the market was down. So they think, I need to take profits. I need to do something that's a bubble. It's overvalued, and they panic. When the market crashes, they panic as well. That they genuinely feel like they've lost money. It's the same biological response as being attacked by a tiger. The brain thinks it's like losing resources. So the emotional panic is something that they just have no control over because they don't understand what they own, because they haven't got the knowledge, they haven't got the learning, they have no conviction. This is all just because they never truly understood what they own. They bought a ticker symbol. If you actually buy the cash flow, the perspective changes entirely. So the stock drop actually becomes the opposite. It looks like a gift. the Benjamin Graham philosophy. So if we buy the cash flow, we do not care about volatility. So many people look for linear solutions in an exponential world. This is something that, when you really look at the core of it, think about what most people do when they want to make more money, make an ROI. They feel like do more effort, make more money, so they work more hours. This is always the solution. And what they're actually doing is you're draining your highest ROI asset. Your cognitive bandwidth is depleted. If someone's working, 50 hours a week, 60 hours a week, grinding, and they're trying to do it through brute force, the brute force method does not work. It doesn't work at all. They try and make more money and just get a bigger shovel, and they're shoveling fiat currency into their pocket, and their cognitive bandwidth is gone. Their ability to think is gone. In fact, they're so caught up in daily life, just daily life's challenges, just to exist, cleaning up the house, washing, fixing the car, dealing with insurance companies, dealing with taxes, dealing with a boss, dealing with traffic, dealing with all the things that life has to throw at you. People have no time to think. So it's equivalent of everyone sitting on a quantum computer and using it to, play ping pong. It's not living up to your full true potential. Your true potential is so much greater if you start using leverage and exponential strategies, because your labor has a hard ceiling. You're capped by your biology. I would rather have 0.0001% of the work of a global monopoly than 100% of my own effort. Where did I get that quote from? I think it was Rockefeller or someone who said that. You've probably heard it before. So the commodity answer is always the same for basic retail finance. It's all you need to do is reduce your outgoings, increase your income, and work as much as possible. Yeah, get 2 jobs, get 3 jobs. And you're fighting gravity doing that, rather than using capital allocation, which I'm going to talk about. Look at the power of one good decision. 1 hour of deep work, true deep understanding of an investment decision can generate 10 years of exponential growth to your balance sheet. In the exponential world, inflation does the heavy lifting for you. The tech monopolies, they do the heavy lifting. All you have to actually do is create conviction. And conviction comes from knowledge. And knowledge comes from learning. Learning comes from using your brain. Your greatest asset is your brain. Action is not progress. I love this because I'm going to show a fantastic example. It feels like progress, but it's usually avoidance. People do not want to sit quietly and assess their life. This is very uncomfortable for most people. They cannot sit in that discomfort. And I thought this was natural because I enjoy doing it. Asking myself the hard questions. Is this even worth the investment? Is this worth the time? And what I found is everyone else is not the same as that. They actually want to avoid that at all costs. And if they're busy, constantly busy on the hamster wheel, they think that is progress. Because normally in the physical world, it is, you do physical labor, construction and work, things happen. But it's not the same in capital allocation. So the hustle culture is a lie. It's 100% a lie because it's linear and they resort to high dopamine work and it doesn't do anything. The great progress is in low dopamine work. That actually is the highest ROI. Think about it. Ask a brain surgeon, did they do high dopamine motivation to become a brain surgeon, or a pilot, or a doctor, or an architect, or an engineer? Think of all these professions. They have a moat because there's a barrier to entry. Yeah? It's the low dopamine activity. And investing, doing nothing correctly is harder and more profitable than doing something. So taking action. This is especially people that try and buy low, sell high. So you're thinking, why on earth do I have a picture of this Bear Grylls? So this is a great example. This was from season 2. Season 2, this isn't the picture of season 2, right? This is the only picture I could find. They dumped a bunch of men on an island, dumped a bunch of women on an island, and says, look, you need to survive. And funnily enough, survival can also be like investing. And what happened is in season 2, as soon as the men were thrown onto this island, their bodies get filled with an adrenaline rush because of the reality of the situation kicks in. And one guy was like a construction manager, and he decided to become the self-proclaimed leader. And he said to everyone, okay, everyone grab a machete, we are going to hack through the jungle and get to the beach. So he just decided we need to just go through the jungle, we need to just take action. So he started hacking through the jungle and just marching ahead. They lost precious sunlight. They didn't have a chance to really even get their bearings. They just took immediate frantic action. And in the survival situation, conserving your energy is more important. So what they would end up doing is like burning 1,000 calories to eat something, like capture an animal, and to eat 500 calories. So it's like they're in a deficit. And that guy, the self-proclaimed leader, ended up quitting in the first day. And what actually in a survival situation is you're supposed to do is observe your surroundings, understand the environment, and plant traps. You know, there's an ROI on the traps on the beach, and planting traps rather than burning calories to eat less. I thought that was so interesting because it was such evidence of this guy thinking frantic effort was doing something, and actually was just make 2 steps forward, 1 step forward, 2 steps back. And something else about high dopamine progress, fake progress, self-help books, yeah. And this is another fake progress. Like I read this book, or the Psychology of Money, or whatever these books are, like Think and Grow Rich, Rich Dad, Poor Dad. You've all heard of them. You've probably read a few. I've read some. We've all been there. And you get a little bit of motivation and then nothing. Nothing. Because it's just a simple fake progress. The real alpha is the video on the right. Yeah. That's his name at the bottom, the lecturer is Aswath. He is fantastic when it comes to learning about evaluating a company. In fact, I would argue, if you could watch that video on the right and you eventually understood it, or even have to grasp it a little bit, you're in the top 0.1% in the global population. I mean, it's argued that only 33% of the global population have basic financial literacy. This is like high level sort of private equity style valuation models, and very few people can understand it. But that's where the actual progress lies. But most people focus on what they see on like a TikTok reel. You're not going to find any alpha on these platforms, yeah. And this is what I've observed, where the true edge actually lies. Learning, you would be so much more of an investor if you understood the valuation metrics. So capital allocation is the meta game. Okay, so you have to play. You have to play. You have no choice. So we should learn it. You must learn it. Otherwise, inflation is going to eat you for breakfast. So you have limited capital, time, money, and focus. So every single month you are investing in something. I hope you have free cash flow to invest. And if you're not investing in the right things, you are bleeding to inflation. Not choosing is still a choice. So you're playing the game whether you like it or not. And this is everyone. The whole global population is in the game. What I'm trying to push here is to effectively have conviction. We're going to have to learn how to look at valuation of companies and understand you're buying the cash flow. You are owning a company, even if you're an ETF investor. Yeah, if you're an ETF investor, you still want to have some understanding of company buying the cash flow, because your investment gets safer the longer you hold your investment. So we buy the cash flow. We don't buy a stock ticker. The stock ticker jumps about, but that's just the game that the retail are playing. Here is an example of a complete asymmetric investment. Apple 10 years ago, 10 years ago to the year, we're in 2026, this is exactly 10 years ago, Berkshire Hathaway made an asymmetric investment. Now, keep in mind, Apple, I believe, was number one in the S&P 500. It had a market cap at the time of 608 billion. This is what I'm trying to push, is people think picking a stock is a needle in a haystack. You have to buy you have to buy Apple when, Steve Jobs was working out of his garage. Yeah, that's what people think you have to do to generate a massive return. But absolutely not. Apple was a large company, the largest, not a small hidden stock. Now, when you look at the valuations, when you understand the cash flow, it's like completely asymmetric. It was so viciously undervalued that it was such a beautiful investment. Market cap, between 530 and 600 billion. So you're buying the cash. It was 5.6 times its free cash flow. So you had a 17% free cash flow yield, and it was buyback in its shares, issuing buybacks to the shares. Total monopoly, obviously on the iPhone. Negative working capital. Some of the highest ROIC ever Apple has. It almost looked fake how high its ROIC is, over 600%. But that's because Apple, the suppliers fund the business for Apple. That's Apple's greatest, one of its greatest abilities. It really just bullies the suppliers. It's TSMC and Qualcomm and these companies fund the business, while Apple has all this cash to put in treasury bills and buy back shares. So the fact is, at the time, a 2% dividend, that's unbelievable. 7% cash back to owners. So Berkshire Hathaway, Warren Buffett, and I think it was Tom Coombs, made the investment. When you actually understand the valuation, it gives you confidence, it gives you conviction. That's what I'm trying to show. Now, this is really important because when back in 2016, someone says, look, the market cap's already 500 billion, 600 billion. So in 2016, someone would say, see, for me to actually make any money, the market cap would need to go to, 5 trillion. And everyone says, well, that'll never happen. Because then what they say is, well, Apple needs to grow at 20% every single year. And then it'll have more revenue than, it'll have 10% of the GDP of the USA is spent on iPhones. That's impossible. And investors don't buy it because it's already big. They think they can't make any money. This is one of the biggest misconceptions, the biggest fallacies in investing, because people think money is fixed. There's a fixed pie. So for Apple to keep growing, it would need to soak up all the money like a big Hoover. That's not how it works. A company like Apple generated a 19% compounded annual growth rate, but not through growing revenue 19% every single year. It doesn't need to grow revenue that much. It can grow revenue by 4% and still pull the levers to give it back to shareholders. So a few examples. Okay, so pricing power. This is why pricing power is so important. Some people think, I don't need to buy a monopoly with pricing power. But there's a huge advantage. Even if it charges like 1% above inflation, CPI inflation, that drops to 8% net profit to the bottom line. So it can capture small revenue growth. It can use margin expansion, so it can push the suppliers down even more. Yeah, this is what Apple's done forever. Operating fixed amortization to add, retires equity. So there's all these levers, yeah. Buybacks, a little bit of revenue growth, a little bit of margin expansion, a little bit of growth. It doesn't need the 19% flat line revenue. That's what a lot of investors think it needs. Yeah. Now, why are big tech monopolies unique in this modern day and age? When you look at old investing textbooks, they don't see this as possible because they lived in a time where everything was about factories and physical infrastructure. So when you look at old businesses, to create more revenue, it had to spend money on factories, sales staffs, inventory, capital intensive. Whereas businesses today, big tech businesses today, YouTube, let's look at YouTube. YouTube could run an extra video ad on all the videos on the platform, and it just pushed its revenue up, 10% or whatever. It does that across all its product lines. In the old days, a company couldn't do that. Had to build a big warehouse, and that cost money, and staff cost money, and infrastructure cost money. So don't think for you to get your 19% return from a stock, it needs to grow every single year, 19%. Here is vital information to preserve purchasing power. Every retail finance creator that you see online, they use consumer price index as inflation. Consumer price index is the cost of milk, bread, eggs, and iPads. If your plan is to be rich in milk, bread, and eggs, track CPI. But when you're looking at investments, you need to use M2. M2 is the cost of assets. So you cannot use the cost of survival when you're measuring the cost of an asset. It's comparing apples with oranges. So when they throw in the compound calculator with your all-world fund, your real purchasing power preserved on an all-world fund, 0.93%. So why is that? So if it's generating, say it's like 7.7 to 8%, 9%, you have to minus off the 7% M2. You do the calculation. The point remains the same. You're preserving wealth. You're really, it's an inflation hedge, if anything. So I wouldn't have a problem with retail finance channels if they just didn't promise wealth, but they keep doing it. Yeah, because they throw a nominal number at the viewer. They say, look, you'll be a millionaire in 30, 40 years if you invest in your 401k and it's in the S&P or it's in the all-world fund. It's actually deception. And it infuriates me, and I had to get this YouTube channel out. What I'm trying to say is real purchasing power. Look at this. Okay, so if you were to, say for the Apple example, the 10% would be roughly 10% real, maybe a little bit more. It's superior by 70 years of purchasing power. Well, look, you're doubling your purchasing power. So if you were getting the all-world fund and it was doing, 8, 9%, your real above M2 is 0.9 or 1%. Call it 1%. The point being is it would take 77 years to double your true purchasing power, especially after taxes. 401k, you have to pay tax. Yeah, that just wipes out all the profit. So the Federal Reserve and commercial banks print money, push the assets up, and you pay capital gains tax for the privilege of phantom gains. Do you see why this is important? This is important because this changes your entire investment plan for the rest of your life, or it should at least help you make future investment decisions. So we don't use CPI. And if you say to me, okay, well, it doesn't matter because I just want to be able to afford the milk, bread, eggs, and iPads. You're a consumer mindset. You're not a capitalist mindset. On this channel, we're capitalist mindset. So there you have it. I'll leave that on the screen. So all world fund, roughly 1%, but after a decade, you're basically still staying in the same spot. It's better than the alternative. Listen, what's the alternative? Not investing. Yeah. Think of all the people that don't invest at all. They're being crushed. They're being obliterated by inflation. Whereas the people that are wealthy and sophisticated, inflation actually is beneficial. And I'm actually not really against the money printer. So I don't know if I've never shared my opinion on it. The system isn't perfect. The financial system isn't perfect, but it is necessary because look at COVID. The COVID was like, if you don't print money, then you can't deal with an emergency. You can't deal with wars. You can't deal with pandemics. So it is just a necessary evil. $4 trillion was printed during COVID, and that's why now you're seeing the effects of it. You're seeing the effects of inflation crushing people who were not invested. There's the chart there. It's on the official website. Every single central bank has an M2. Whatever country you're in, you can look at your M2 on your central bank's website. On the screen here, you actually see 2020. See that big jump line? That's about $4 trillion injected into the economy. 2022, it for the first time ever, it went down slightly because interest rates were high. Commercial banks were not lending as much, and it went down slightly for a short period of time. But if you look at the S&P chart and tie it to the M2, it's pretty much a direct match, because that's why assets go up, because of printed money. And anything above M2 is real productivity. Like right now, the past couple of years, because of AI, it's an industrial revolution. It's not printed money that's pushing the market up. It's the hyperscalers. The hyperscalers are spending trillions of dollars, and that's going into real companies, and their earnings are going up, and the stock market goes up. But you cannot rely on that forever. Yeah, so the S&P is obviously better than the All World Fund, and the Nasdaq 100 is even better than the S&P. But all the money goes to the same companies. The power law. So what is the takeaway? A taxable brokerage. See, a taxable brokerage is so ironic, because it can actually be the most tax efficient system on earth, because if you do not sell the asset, you do not pay the capital gains tax. Now, I personally use Interactive Brokers because it has a massive institutional advantage, yeah, because it's got the cheapest fees compared to other platforms. It has massive lowest margin rates as well, so you can actually get a negative true cost of debt, because if the money supply for the year is up 6% and your loan is say 5%, the true cost is like -1. Yeah, you can do the geometric math, but you get the point. So cheap, it's very cheap. Interactive Brokers is very cheap for your transaction fees. It's, I get comments with people saying, because they're with Fidelity, I think, like they're saying, the margin is costing 10% or whatever. Really, unless you've got a prime brokerage with JP Morgan or Goldman Sachs, Interactive Brokers is the only other alternative. Global markets, you can buy treasury bills, you can invest in global markets. And if you're in America, you can just use margin loan for lifestyle events if you want. Very cheap, and it's a healthy company as well. Fortress Custody, $14 billion on the equity, I believe. And your margin loans do not need serviced. Your assets can service them, your dividends can service them. And you do not need to sell the assets. That's the whole point. You let inflation do the heavy lifting, you let the company do the heavy lifting. And I mean, I could probably make a whole video on Interactive Brokers actually, and how I can compare it to a bank. Yeah, when your money's in the bank, you are giving the bank a loan. So your $1,000 in the bank is a loan to the bank. The bank owes you that money. When you have assets and shares, that is a segregated security, or treasury bills. That's even safer than just raw cash. But there you have it. Your greatest asset is your brain. The greatest asset. We spend more time learning and understanding. Do you know what? All you need to know is this information exists. You don't necessarily need to sit and read a 10K. I love doing it, so I will put it on the channel, and I'll start a community where I'll actually put the valuations of companies, and if there's asymmetric opportunities where we can get fantastic compounded annual growth rates, that's what we're looking for, because we want to beat inflation. We don't want to be a victim to it. And that's why we compound our knowledge first. Thank you.